On December 2021, this was tweeted at Elon Musk. A day later, he replied with this: Recession. Recessions cause some of the worst market crashes in history, and the word itself is enough to cause fear and panic in the streets. So why does Warren Buffett, one of the richest men in the whole world, hope to see a lot more of it? After studying him and other famed investors for years, I now know why. But first, is an economic recession and market crash really on the way? And probably what you're way more interested in is how can you profit off of one? The past couple of years have been chaotic, to say the least. The illness was a catalyst that led us to the current economic situation of labor constraints, exponential housing price, supply chain issues, international tension, political instability, uncertain economic growth, and record inflation. But what does this all lead up to? Check this out. The current inflation rate is over 7% and is the hottest since 1982, and it's no secret that the Fed knows that this number is way too high, which is why they're planning to increase interest rates this year. But there might be something even more sinister waiting on the other side because of this. Dealing with interest rates is like Dr. Strange playing around with time. It requires a very fine balance at work. Otherwise, okay, let's pause. First, you need to understand the two main impacts that interest rates can have on the world economy. Lowering interest rates makes borrowing money cheaper, increases spending, and speeds up the economy, which is what the Fed did and wanted during shutdowns. Raising interest rates makes borrowing money more expensive, reduces spending, and slows down the economy. But what if the economy isn't ready for a change? Seriously, did anyone bother asking her if she's cool with it? Pulling the interest rates lever ultimately comes down to perfect timing. If the Fed increases interest rates too quickly before the economy is ready for it, it could cause a chain reaction that tanks the domestic and global economy. But surely the Fed is aware of this and they're going to be very, very careful, right? Well, not necessarily. This chart shows the number of recessions or financial crises after historic interest rate hikes. The 1980 recession, saving and loan crisis, housing market bust, automotive industry crisis, 1990s recession, tech bubble bust, Great Recession, housing bubble bust. The Fed hasn't always been the best in handling this type of situation, but I guess neither was Dr. Strange. But listen, recessions aren't just about interest rates. It's also about this other thing. The definition of a recession is when GDP declines in 2 successive quarters, and GDP is the total value of everything produced in a country over a given period of time. Therefore, we'll need to look closer at the GDP data, and thankfully, the latest GDP numbers were astounding. In Q4 of 2021, GDP surged an impressive 6.9%, closing out the year with a 5.7% annualized increase compared to 2020, where GDP actually declined 3.4%. So we're good, right? Cool, I'm out. Not so fast. Check this out. There's something the media is hiding from you in this data, and here's where it gets really interesting. Most of the year-end GDP gain, about 4.9 of the 6.9% or 71% of it, was actually fueled by businesses stocking up on inventory and not necessarily from consumer demand. If we look at the ISM manufacturing data, yes, we're seeing new manufacturing orders still being placed, but that growth in new orders is slowing down substantially. In fact, Wall Street and smart money are also becoming more pessimistic about how much the US will grow in 2022. Goldman Sachs slashed its full-year growth forecast from 3.8 to 3.2%. Bank of America knocked it down from 4 to 3.6%, and Wells Fargo cut it from 4.4 to 3.9%. These numbers aren't looking great, and it definitely does not make me a positive Peter about the short-term future of the United States. But still, it's not just interest rates and GDP that we need to examine. There's one more thing that is commonly viewed as the leading indicator of recessions and has preceded every US recession over the last 50 years. This innocent-looking little line. The yield curve. The yield curve shows you what happens if you buy a US government bond, specifically the different interest rates that you would receive over different investment time horizons, like if you held the bond for 5 months or 5 years. Normally, you'd expect the longer you hold the bond, the higher the interest rate you would get, which isn't surprising because the longer horizon means the more risk and uncertainty for you. Where it gets dangerous is when this yield curve starts inverting. When it switches, it throws the entire system out of whack, and now means you would get a higher interest rates if you held your bond for a shorter period of time, which doesn't make any sense. This inversion happens when investors are feeling very bearish about the future and generally believe that a recession is coming. Now, good news, the yield curve hasn't inverted yet. But there are signs that it is the flattest it's ever been since 2020 and could potentially be inverted soon. Now, I want to make something perfectly clear. I have no idea what I'm talking about, despite having an economics degree and working in finance for a couple of years. No one, absolutely no one, knows when a recession or a market crash is coming. And people have been predicting one for every single year since 2014, 2015, 2016, 17, 18, 19. And still, the S&P 500 has kept chugging along, but given the current economic situation, is now the year when the train stops running. I've studied nearly all the great investors from Baron Rothschild to Warren Buffett, and now I know why Buffett hopes to see a lot more recessions. And it can be summed up perfectly with this quote: "Be greedy when others are fearful, and fearful when others are greedy." The legends who profited from the 2008 crash followed these strategies to the T. Despite the stock market falling, housing prices falling, businesses falling, employment falling, savings falling, if we zoom out from this scary graph in 2008, you can see that the crash was just a very small blip in the grand scheme of things. Let's say you had invested $20,000 into the S&P 500 around 2007, before the economic crisis. If you had pulled out your money when everyone else was doing the same around May of 2009, you would have lost around 31% of your money, leaving you with $13,800. But if you had only implemented a fourth of the strategies I'm going to reveal, today you would have close to $50,000. Look, I'm not going to BS you. Profiting during a market crash is easier said than done, because psychologically, when you see red all around the market, you're gonna panic and you're gonna want to sell. And you go online and it's not gonna be much better. You see people chanting sell, 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 with plans to re-enter the market when it's done crashing. But here's why that doesn't work. You can't time the market, and when you think you can, you're making two really bold guesses. One, that you know when the market has reached the bottom and you're able to get out at that exact time. And number two, you know when the market is going to go back up and you buy back in or very near the bottom. And unless you have Mr. Magic Lamp over there, there's no way you can predict the future, and the odds are not in your favor. A study conducted at the University of Michigan measured returns from 1963 through 2004 and found that 96% of the positive returns over that period came from 0.85% of trading days. Separately, one of the top equity analysts in the world, Andrew Stoltz, looked further into this phenomenon. He observed a 10-year period from November 2005 through October 2015 and ran the data through several simulations and concluded that if you missed the 10 best market days over the specified 10-year period, you would stand to lose on average 66% of the gains you would have captured by just staying in the market. In non-fancy speak, the message is when the market moves up, it will move up very, very quickly. And if your money is on the sidelines, you're gonna risk missing out on some of the best days the market has to offer. So stop trying to time the market and stop panicking. But what should you do instead when the streets are on fire? 3 words: dollar cost average, or DCA. It's an investment strategy where you buy X dollars worth of stocks during a fixed interval period. For example, you invest $200 into Microsoft every single month for 5 years. If you're investing a fixed amount of money each time you buy, you get more shares when the stock price is lower and less when the stock price is higher. And over time, this will minimize the cost per share you pay for a given stock. Here's how it works with mathematicals. If you have $300 to invest and you're looking at a very volatile stock called Magic Lamp Incorporated, where in the first month it's $10 per share, in the second month it's $5, in the third month it's $20. Here's where dollar cost averaging comes in. Say you want to invest $100 a month for 3 months. At the end of the 3 months, you bought 10 shares in the first month, 20 shares in the second month, and then 5 shares in the third month. So now you have 35 shares for $300 for an average price per share of $8.57. Your price per share isn't the cheapest at $5 per share, assuming you can tell the future and you bought everything in the second month, but it's also not the most expensive at $20 per share. Now, there are studies that in the long term, it might be more effective to just invest all your money at once as a lump sum to get better returns. However, during a recession and market crash, many challenges pop up in this scenario, especially the psychological fear that makes you panic and prevents you from investing. Which is why I personally believe that DCA during volatile times is a better option than lump sum investing. In fact, there's actually a study that shows during a downturn, people who put all their money at once in the stock market saw a loss of 22.4%, while those who put their money periodically throughout a period of time only saw a loss of 17.6%. Now, a 5% difference in loss averted might not look like much, but if you have $100,000 invested, that would be about a $5,000 difference, which is enough to buy 5,000 $1 cheeseburgers from McDonald's. Okay, but what if you don't want to buy 5,000 cheeseburgers? fine, whatever, your loss. What should you be investing in, since the key is to continue dollar cost averaging into the stock market? Well, the easiest option is a diversified index fund for some modest potential returns. But what if I told you something very shocking? That not every stock performs poorly during an economic downturn, and there are ways to determine which ones could perform well. Think about it. If the recession happened tomorrow, what are you gonna do? You wake up, your boss calls you and says you're fired, you see the stock market crashing, companies are laying people off, there's panic in the street. Do you still go out and buy organic, free-range, vegan-friendly kiwis from Whole Foods? Or do you go to a more affordable place, like Walmart or the dollar store? During the 2008 recession, the #1 performing stock in the S&P 500 was Dollar Tree, with a 1-year return of 60.8%. Compare this to the 2008 return of the S&P 500 of -38%. Walmart also did well, 20% yearly return. H&R Block, a tax preparation company, was 25%. Ross, a cheap clothing company, jumped 17.6%. But the top recurring industry in the top 10 best performing stocks during the 2008 recession was healthcare stocks. Now, all these categories make intuitive sense because during recessions, when incomes go down, people will buy fewer things and substitute for lower priced goods. But there are always some staples that you need no matter what that you can't really just cut out, like food, clothes, healthcare, money management, and these types of stocks shined in the 2008 recession. However, I'm not saying that these stocks are guaranteed to do well in the next recession. I can't tell the future, so make sure you do your own research. One of the most important things to do to maximize your profits during a recession is to reduce your overall spending as much as possible. And it's not for the reason that you think. Yes, I understand there are some essentials that you absolutely need to buy, but explore cutting down on the unnecessary ones, like Netflix after you finish Ozark, not only because the job market won't be the best during the recession, but because you can use that extra cash flow to supercharge the investing strategy that we just talked about. Imagine how much more you can profit if you can invest just a little bit more into the market during its downturn. But this should only come after all your important financial things are tied out, such as making sure you have enough to live, having a 3 to 6 month emergency fund, etc. But listen, I get it. The last thing on people's mind when there's an economic crisis is to invest money. It's psychologically taxing and you naturally want to go into capital preservation. But here's a fact that you need to know. Recessions are a natural result of the ebbs and flows of an economy, and they're a lot more common than you think. Since 1945, the US has undergone 10 different recessions, which on average lasted around 11 months. And if you looked at a graph like the S&P 500, you can actually see the line going down in September 2008, and around 11 months later, around August 2009, you see a sharp turn towards recovery. The market will always bounce back. But before you can invest, it's insanely important for you to know the easiest way to manage your money, because you might be doing it all wrong. Check out this video that will absolutely revolutionize your entire financial life.